What is going on with interest rates? Since the beginning of 2022, it feels like we have been on a roller coaster in the markets. We've got stock markets doing things. You've got the interest rates for mortgages doing something. We're getting bombarded with statistics like unemployment rates and inflation rates. And we've got the Fed meeting and changing their interest rates. So what does it all mean? We're getting a lot of questions from folks with just uncertainty about what it all means, how rates are moving. And in particular, the common theme is questions about if the Fed is meeting and increasing their rate, does that mean that the mortgage rates are going up too? In particular, they're asking if the Fed moves the Fed funds rate, are 30-year fixed rate mortgages going up as well? And the interesting thing is that if the Fed's doing what they're supposed to be doing as it relates to interest rates, the reality is a 30-year fixed rate mortgage should go down when the Fed meets and drives up the Fed funds rate. Let me explain. So when the Fed meets and makes a decision about whether or not to move rates, what they're really moving is something called the Fed funds rate. So it's the rate that banks lend money to other banks on a very short term. So they're required to hold reserves if they're short, because deposits come in and out over the course of a day, and Wells Fargo needs $3 billion from Bank of America or something like that. They'll lend it overnight for this Fed funds rate. So it's a lower rate in the market. Big institutions lending money to each other. That is the target. That's the Fed interacting in that market to control and try to manipulate that rate to a particular target with the intent of kind of moving the economy in a certain direction and changing rates. The prime rate is typically measured right off of that at 3%. So we have a Fed funds rate of something, currently 1.75% as of the recording of this video. And the prime rate is 3% above that. So currently 4.75%. So the Fed funds rate is the rate that banks are borrowing from each other. The prime rate is commonly thought of as the rate that like a prime borrower and a most well-qualified borrower would be borrowing money at this prime rate. Those are both still relatively short-term rates. The Fed funds rate is a very short-term rate. Mortgages aren't measured in overnight and days. No one gets a mortgage for 3 days or a week. You get a mortgage for 30 years or 15 years or something like that. So really over the long haul, there's something else that's the primary driver of whether rates should be going up or down. That is inflation. If you think about if you lend $1,000 to your friend at 3%, then over the course of a year, you get $30 in simple interest. You get $30 and you lend them $1,000 and that's on repeat. Well, if you had done that last year and then you come into this spring and the cost of everything has gone up, the cost of gas, the cost of food, the cost of all kinds of stuff is more expensive. Your $30 doesn't go so far. You can't buy as much stuff with the $30 you're getting on that money. So maybe going forward, if you're lending your next friend $1,000, you don't want $30. You need $50 or you need $60. So that interest rate you're going to lend is now 5% or 6% or something like that, so that you can accommodate and pay for this increase in goods and cost of services driven by inflation. So in the very, very short term, you've got this Fed funds rate and you've got floating rates like the prime rate that's typically floating and connects home equity lines and credit cards and things like that. As the Fed moves, it's driving those rates up. And yes, there's going to be an increase in those rates. On the other side of the spectrum though, we got mortgages on really long-term debts. They're looking more as if the Fed is successful in driving up the short-term rate to mitigate the long-term inflation. That is what is impacting the long-term rates. So the question is, are they doing enough? Is it successful? Those are all the variables that are at play there. But when you see the Fed driving the rate up with a goal of trying to bring down inflation, ultimately, if inflation is in check, you're not going to see a runaway in the long-term mortgage rates. Over time, the same amount of money that's coming in for these rates and these dollars that you're lending out, if you're lending that $1,000, right, that $30 is going to be able to pay for a stable amount of goods over time. If the cost of that stuff is increasing, you're going to see the rates increase as well, because the institutions are going to need to collect a higher amount of interest in order to pay for all of those things that they need to pay for over the course of time. So that is what's driving it. As you're watching the markets, there's a lot of other factors that go into it from a day-to-day movement standpoint. But if you're just looking big picture, the thing that you're looking at long-term is if inflation continues to drive up and up and up, we're going to see long-term mortgage rates typically follow, and they're going to go up as well. If the Fed can be successful at getting inflation in check and bring inflation to a stable or a decreasing number for the short term here, we're going to see a longer term horizon that says, okay, we don't have to have as high of a 30-year fixed rate mortgage to offset that. So if you've got more specific questions, you want to reach out to the Kristoff team, we can share some more insight to you, but we've got a lot of questions about that, and it's just been a crazy several months here of stuff moving around in those markets, and we thought it would be helpful just to share a little insight of what's happening behind the scenes and what's driving these rates.